What's going on, everybody? Welcome back to another episode of the Financial Freedom Show with Chase Lawson. For those just tuning in, I am a personal finance enthusiast and the author of the best-selling book, Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth. Today, I wanted to come back at you, this time with a couple of important financial concepts to be aware of, along with the implications of each. The first concept is what is known as time value of money. What time value of money essentially means is that money you have today is worth more than the same amount of money at any future date. So $1 today is worth more than $1 tomorrow. This is true for a couple of reasons. The first is due to inflation. Over time, the value of goods and services will continue to rise. For example, in 1960, a first-class stamp cost 4 cents, a gallon of gas cost 31 cents, and a new home cost $16,500. 30 years later, in 1990, these numbers rose to 25 cents for a stamp, $1.16 for a gallon of gas, and almost $150,000 for a new home. So for $1 in 1960, you could buy over 3 gallons of gas, but in 1990, you couldn't even buy 1 gallon with that same dollar. The second reason is because your money actually has the power to earn you more money, whether it's through interest or through returns on an investment. So when presented the option of receiving an equal sum of money today versus a future date, always choose today, unless, of course, you think interest rates will drop below zero, which is unlikely in the US. But what if you were given a choice between a certain amount of money today or more in the future? How do you determine which is the better option? At that point, it simply comes down to what you anticipate you'd be able to earn on that money and how long the time period is. You can calculate the future value of a sum of money by using a future value formula, which is future value equals present value times 1 plus I to the nth power, where I is the projected annual interest rate and n is the number of years. You can also find a future value calculator online and use that to help out if you need to. So for example, if you are given an option of receiving $10,000 today or $15,000 in 5 years, and you expect to earn 7% on that money, the future value in 5 years of the $10,000 equals $10,000 times 1 plus 0.07 to the 5th power, which equals $14,025. In this scenario, it would be better to take the $15,000 in 5 years. You'll oftentimes see lottery jackpot winners given an option of either a lump sum payment today that is less than the total of grand prize that they won, or receive the full grand prize money, but over a period of annual installments spread out over several years. This concept is exactly what happens in those scenarios. The second concept is a related concept and is what is known as compound interest. This concept is such a powerful concept, and it's a great one to understand. Compound interest is where your money actually earns you more money due to compounding. This concept is very simple once you understand it. So let's say you have $10,000 and you have it in a high yield savings account earning 2% interest. With simple interest, you earn that interest rate only on the principal amount, or $10,000 in this scenario. So year one, you earn 2% of $10,000 in interest, which is $200. Year two, you're still paid on only the principal, so you earn another $200 in interest. This is how bonds typically work. Standard bonds pay you a flat percent based on the face value each year. Compound interest, on the other hand, factors the interest on the entire sum of your money, including any previously earned interest. So in this case, you would still earn $200 in interest year one, but then in year two, you now have $10,200 earning interest at that same 2% interest rate, which means that in year two, you would earn $204 in interest. It's a small increase, but over time, this will continue to grow even further and compound on itself. This is how investment vehicles like the stock market or your savings account operate. This is also likely how any debts you owe work as well, which is why if you don't pay your debts in full each month, they'll continue to accrue more and more interest. And the more frequently institutions choose to compound your money, the more impact compound interest will have, and the more this money will grow. So if they compound monthly versus annually, you'll either earn more on your investments or owe more on your debts. So what does this mean to you? Well, for one, it's all the more reason to start investing earlier. In fact, if you invest $250 per month at an 8% annual return, your money will be worth $878,000 by the time you reach age 65 if you started investing at age 25, but only $375,000 if you started 10 years later at age 35. That is a difference of over $500,000, even though you would have only invested $30,000 more. By simply starting sooner, your earnings will build upon themselves and leave you more to fall back on in retirement once you stop bringing in money from your employer. No matter how old you are, it's never too late to start investing. So thanks so much everyone for tuning in to the Financial Freedom Show with Chase Lawson. I hope you learned something new today and are ready to start applying these concepts into your own life. And as always, I appreciate any feedback you can leave, so make sure to leave a comment and let me know your thoughts or what questions you have. And as well, leave a like or review if you got value out of this so that more people can find this information organically and benefit their own financial lives as well. And please subscribe if you have not yet already. Thanks so much, everyone. Until next time, stay safe and go get 'em.